What's going on, guys? In this video, we're going to be learning how to live off your dividends. I'm talking about this is your only income because it's all you need and it's enough to sustain your lifestyle. Whatever that lifestyle may be, I know everyone has different goals or different expenses in life, but a big goal for a lot of investors is to completely live off of your dividends. That means you don't have to work another day in your life because you make more than enough money from your dividend stocks. But a lot of people go about it the wrong way and they'll go for these big yield traps and they just invest in the wrong stuff, and then it's something that you can't sustain. So I'm going to show you what I would do if I was trying to live off my dividends. That's not my current goal, but in 10 or 20 years, maybe 20 or 30 years, this is definitely something that I plan on doing. And this is exactly how I would pick those stocks to do this. Now, this is not financial advice in any way, shape, or form. This is purely for education and entertainment purposes only. Consult a financial advisor before you do anything. So before we dive in, guys, smash that like button and subscribe to my channel if you haven't already. Check out my channel too. I got tons of awesome videos teaching you about the stock market and Bitcoin and all that good stuff. And I want to give a quick shout out to Delta Investment Tracker. This is something that I use almost every single day on my phone. It's available for both Android and iOS. You can track everything all in one place with this application with a gorgeous layout. You can track your crypto and your stocks all at the same time, so you don't have to jump between several different brokerage accounts or several different applications. It's just all there in one spot. A link will be in the description for you to not only download it, but then also try out the Pro version for free for a month. So again, link in the description, but let's dive right into the video. So there's a lot of ways that you could pick a stock, especially when we're looking at dividend stocks, but these are the three most important things to me: the dividend yield, the dividend growth, and the payout ratio. The payout ratio may be the most important in my books, but when you are looking for high quality dividend stocks, these three fundamentals are so crucial when you're picking the right stocks. Now, there's more than just these three criteria. You need to trust the company, you need to believe in it, all of that good stuff. And you should have some kind of basic background on picking stocks. But this video is going to focus on these three things, which I believe is the most important when looking for dividend stocks. And the very first thing, dividend yield. This may surprise you, but if you are looking for a high quality dividend stock, you want to yield anywhere between 1% and 4%. Now you may be thinking 1%, if I'm going to have a dividend yield of 1% and I want to make just $10,000, that's $1 million portfolio that I need to have. To sustain a healthy financial lifestyle off your dividends, it's going to cost a lot of money. Don't think you're going to be doing it with a couple $100,000. You're going to need to invest some serious money. And in fact, we're going to pull up the calculator and we are actually going to do some quick math, because this is what you are going to have to decide. How much money do you need to live off of? So let's say you're someone that needs $50,000 a year. That will pay for all your expenses, any kind of recreational, and then be able to go on vacations, do whatever you want. You need 50 grand a year to figure out how much you need invested if you're getting, say, a 4% yield. To figure that out, we do divided by, so you want to take the 50 grand divided by 0.04. So whatever you think your yield is or your target yield is going to be, you divide that $50,000 by that target percent. So we're going to say 4%. We need a portfolio of at least $1.25 million. So again, this isn't something where you have a couple $100,000 saved and you think you're a genius and now you can live off your dividends. Chances are you're not going to. You need a substantial amount of money. And if you're someone who's younger that's watching this, you're in your 20s or 30s, start investing now, because then when you're in your 50s, you can easily have a portfolio of this size as long as you made some smart trades, smart investments, and you were investing aggressively in the beginning. So 4% is attainable, but let's try to be a little bit more conservative. Let's say we want to go for 2.5%. For me, I think that's a sweet spot. I can feel comfortable with that. So 50,000, and I'll explain what I mean by sweet spot in a second. So 50,000 divided by 0.025, hit enter. So $2 million. I would need a portfolio of about $2 million to live my life making $50,000 a year in dividends, and that's it. So why did I come up with this 2.5? Well, that's because as a stock moves up and down, your yield's going to change. When the stock goes down, the yield's going to get higher. But when the stock goes higher, the yield is actually going to shrink. So right now we're pretty overvalued, or at least I would say we're pretty overvalued. So I would want something that has maybe that 2.5%, because if we do get that nice dip, we'll be back in the 4%, and it won't jeopardize that range, because when you get a yield that's too high, chances are the stock's not going to be able to make that dividend payment, and the dividend will either have to be cut or they won't pay you for that quarter. So now the next thing, dividend growth. You want to find a stock that's between 5% and 20% for its dividend growth. Think of just like the normal stock market. You want a stock that is going up in value so then you can make more money in the future. So you want to find a stock that has good dividend growth. And a great example of a stock that has an absolute stellar dividend growth rate is Target. Not only does it have an amazing growth rate, but Target's actually been a dividend king. That's when a stock is able to increase their dividends every single year for 50 plus years. Target has been doing this for 53 years straight, and its current growth rate is 17.9%. So that's within my range between 5 and 20%. And here's every single cash payment from Target over the course of, well, this is from 2012, but if we go down here, you could see there has been a steady growth every single year, and it's been growing for the past 53 years. And then lastly, and most importantly, at least to me, is a payout ratio less than 70%. So a company makes money, and then after it has all of that earnings, it wants to give it to its shareholders. You want to make sure they're not giving you 100% of what they make. As a company, you want them to reinvest that money. Pretend you're a small business. Maybe you're making $100,000 a year and you have investors. You're not going to give them $100,000, every last penny. You want to save maybe $30,000 or $40,000 to reinvest back into the company. Maybe give employees raises, buy new equipment, make new investments within the company. So I always look for a payout ratio less than 70%. An awful example of a payout ratio that's too high is AT&T. We'll jump to the payout ratio in a second, but if we look over the past year, AT&T has been taking a dive. It peaked at $32 this year, and right now it's currently at $24. So it has not been doing too hot. And then if we look at the dividends, it's saying its payout ratio is 1,600%. That's impossible for them to pay that. Just picture if you are a company with that $100,000 and you're not paying out 100%, you're paying out 1,600%. You're paying out $1.6 million. Do math quick. Hopefully that's right. Let me know in the comments if I screwed up. But you would have to pay out your investors $1.6 million. Meanwhile, you only made $100,000 that year. Where's that money coming from? Are they taking on more debt? And if they are, I wouldn't want to be an investor in that company that's taking on massive amounts of debt just to pay its shareholders. So now that we know what we want for the three, dividend yield, you want between that 1 and 4%. Dividend growth, you want between maybe 5 and 20%, and payout ratio below 70. That's my criteria. You could tweak it as you want because, again, this is my opinion and not financial advice. But how are we going to find stocks that hit those three criteria? We're going to jump onto a website like Finviz that has an amazing free screener. And if we jump over to screeners, we could screen through that stock. So dividend yield, we want in between 1 and 4%. So we'll just say over 1%. And then if we jump up here, fundamental, we can then go to payout ratio. We want it less than 70%, so under 70. And then that will filter through. We now have 1,000 stocks to look through. That is a lot. I don't have the time to look through that. I wouldn't be surprised if you don't either. So we could just put in some other information. For example, for me, I don't want to invest in anything smaller than $10 billion. I want it to be a big company. We're down to 271. And then you could tweak other stuff if you want. But for me, I think a couple hundred stocks is a good starting place. I'm not going to look through every single stock. What I'm actually going to do, which I would encourage everyone to do, is you don't want to invest in some random company that you've never heard of before. You want to find companies that you actually know. Allstate. So I know Allstate. What's my thoughts on it? I know what they do as a company. It's pretty straightforward. It's insurance. So is this a company I would want to invest in? Well, then I could do some research and type in its ticker. Now I'm on stockanalysis.com. Here's Allstate Corporation. And then I can do the research. Its payout ratio is 27%, which is really good. Its dividend yield is 2.8. I like that number a lot. And its dividend growth is a little high. It's 50%. That's probably not so sustainable. I doubt it's going to stay 50% forever. But I do really like the other two. So this could be one that I would consider. It marks off 2 out of the 3. And if I go back, I could see that besides these couple of quarters, it's paid its investors every single quarter since it looks like 2014. I don't know what happened there, but it was pretty consistent with paying. So it could be a good contendant, but it's not the best one. The dividend growth is a little high. So if we go back to the screener and I go down, I do know Ally Financial. So ALLY, we take a look at that. Dividend yield is 1.85%. It's on the smaller end, but it's still within my range. Payout ratio is less than 10%. That's really good. And its dividend growth is strong. It's 15%. That's sustainable in my books. And it looks like it's been paying since 2016. And it hasn't missed a single payment. So this would be something I would probably want to consider. Ally would definitely be better than Allstate in my books. And then it's always good. You may want to just look at some other important stuff. What's the market cap? What's its financials? Because you're not just basing it off of those 3 things. You got to do your own research and figure out, okay, good. Its revenue has been increasing each year. Its gross profit is looking good. You know, all the basic stuff that you do when you're picking stocks. Its EPS. All right, that was a little low, but its EPS is looking pretty good, especially over the past 5 years. So this is definitely a company I would highly consider. We'll just look for one more. Let's go to like section 6. Well, page 6. It's Ford. All right, we'll look at Ford. So jump back over. Ford has actually been in the up and up in the recent years. I think they just recently changed CEOs, so it's going in a different direction. You can see the past year has been amazing. And if we actually look at its max, was in a pretty big bear market since 2012, but things seem to be turning around for Ford. Let's look at its dividends. All right, so this is off the list already. Payout ratio and dividend growth are NA, so I really don't even care for it. Even though it has been paying every single quarter, doesn't matter. It's inconsistent, so it's something that I don't want to look at. That's off the list. We'll just jump to another page really quick. All right, here we go. Lockheed Martin, LMT. It's an aerospace company, LMT. So good dividend growth, great dividend yield, 3%, and payout ratio, 47%. Those 3 checked off. Let's scroll down. Amazing dividend growth and consistent payments since 2012. And they probably get, I know they get a lot of government contracts. So, that's guaranteed money. And I'm sure their financials look nice. So, their revenue has been going up for the past couple of years. Their net income is looking pretty good. Wonder what happened in 2017. But besides that, it's been looking really good for them. And I'll even go one further and look at how about free cash flow. Very steady with free cash flow. And you know what? I'll even do this too. Another one that I like to look at is their debt to equity. It looks like they've kind of been managing their debt. It was a lot worse back then. Their debt's still a little high, but it's nothing too bad. So this is definitely a company I would consider. So I'm helping you guys understand what to look for here. It's these three things are the big ones: your dividend growth, your dividend payout, and your dividend yield. And if I were to compile a list right now to try to live off dividends, if I had that $2 million in the bank, I would probably pick between 15 and 30 different stocks. You want to make sure it's diverse enough where, God forbid, something happens to one of these stocks. If Lockheed Martin were to ever file for bankruptcy, I highly doubt they will in the foreseeable future. But if they were to, I wouldn't want this to necessarily hurt my income stream. I would have another 14 to 29 stocks that I could rely on to pay me. But if you're someone that doesn't want to sit down and do that research and come up with 15 to 30 different stocks to live off your dividends, you could always just invest in a dividend ETF. A big one is the SDY. And if we go over to dividends, look at this. This already meets my three criteria. Its dividend yield is 2.71%. That's pretty good. Its payout is 45%. And its dividend growth is 12%. So that checks all three of them off. And what's even more impressive, if we go over to holdings, it is currently holding a total of 116 stocks. So I'm not that worried about AT&T. AT&T only being less than 3% of the entire portfolio, with its outrageous payout ratio of 1,600%. If it were to stop paying its dividends, that's only one stock out of 116 different stocks. So if that one doesn't pay, that's okay, because I have 115 other holdings that should pay me the dividend. So this yield should stay very stable. This payout ratio should stay very stable. And I should have a very stable dividend growth with this ETF. And if we look at the chart, over the past 5 years, it's also had some price appreciation. 5 years ago, it was trading at $85, and now it's currently trading at $126. So that will help my yield on cost, my appreciation, and all of that good stuff as well. But guys, that's all I got for you today. This is how you can live off your dividends. If you like this video, smash that like button, subscribe if you haven't already, and as always, I will see you in the next one.